Hello guys, this is Albert, AK, or you can call Prince. So today we are going to handle an account of $50, 50 USD. So we want to see how best we can grow this account. So what we are going to trade is currencies. So we are going to trade currencies on our $50 account. So first thing you have to ask yourself, one lot size is equals to 1,000 USD without leverage. This is one standard lot. Okay, this means for us to be able to open one standard lot, we need to have 100,000 US dollars, but our account is $50. So if we narrow down to 0.1 lot, this means we need to have 10,000 USDs. If we narrow down to the 0.01 lot, we need to have 1,000 USD. But still, this can trade. So here is where leverage comes in. So for us to trade account of 50, at least on a minimum of 0.01, we need a leverage of divided by 50. At least a leverage of 1:20 for us to be able to trade 0.01 lot on account of $50. Okay, but this one is very small for us to be able to trade that. So what are we going to do? So we are going to trade something we call send account. Why are we trading send account? 1 USD is equivalent to 100 USD cents. Okay, so if your account is $50, our balance will be reading 5,000 USD cents. Okay, so this means that we'll be able to trade huge lots with our account of 500 USDC, 5,000 USDC. So let me show you how you can easily generate an income with an account of $50 as compared to trading a standard lot. So this column is for standard lot. You have seen clearly you will be trading a minimum of 0.01 lot on a very small that we call a leverage. So let's do with a 50 USDs, which is equals to 5,000 USDC. So the first thing you have to ask yourself, how many lots am I going to open? Because I'm very sure some people have never traded an account of $5,000. So we are going to train ourselves to trade this account as if it was 5,000 USD. Okay, so how are we going to do? How are we going to calculate the lot size on these? So for us to calculate the lot size on these, we need to introduce a formula. So my body is going down. We need to introduce a formula. And this formula will help us to calculate the lot sizes. So how do we calculate lot size? Lot size equals to this is the formula actually. Lot size equals to account balance. Actually niandike account bal. Okay, account balance multiplied by risk factor. I'll explain this. Risk factor. Okay, multiplied by risk factor or risk tolerance. Okay, risk factor or risk tolerance, all these divided by divided by the stop loss times the pip value. In our case, since we are trading currency, the pip value is 10. Okay, so account balance multiplied by the risk factor divided by stop loss. So what is our account balance? Our account balance equals to 500 USD. We can call them USD, but we know there is an S, of course, USDC, not S, USDC. Okay, so we are treating it as 5,000. Eh? So what is our risk factor? Risk factor is like how much are you willing to lose? So in our trade here, we are willing to lose, let's just take for example, we are willing to lose at least 10%. At least 10%. When stop loss hits, we are going to lose 10%. So 10% becomes our risk factor, okay? So if we lose 10% of this account, our loss will be 10% of this is $500, 500 USDC. Okay, so we still have a balance of 4,500. Eh? So this is equivalent to $5. So that's what I'm saying. Okay, so let's do our account balance. The risk factor tumesema ni what you're willing to lose, and then this is our risk tolerance, RT, and then we have now to calculate our stop loss. So we are going to do day trading. These are day trading, which can also be converted to swing. If we feel like our orders are not working, we can always tolerate them to a swing trade. Eh? So that means our target for most currencies is between 50 USD, 50 pips, 50 pips to 100 pips movement in a day. These are movement in a day. So we have like 50 pips to 100 pips movement in a day in most currencies. So how are we going now to know our factor? So let's come and settle somewhere in between to get our stop loss factor here. So we can say that on a bare minimum, this is a stop loss. On the higher side, this is a take profit. This is a stop loss, sorry. So on the lower side is 50 pips, on the higher side is 100 pips. So let's take on the lower side all the time. So our stop loss equals to 50 pips. So we are going to use something we call the risk-reward ratio. Risk-reward ratio, RR, risk-reward ratio. So we are going to use our risk-reward of 2, meaning we are risking 1 to get 2. To hesabu mnaelewa what I mean, eh? We are risking 50 pips. So if our risk is 50 pips, so we are going to get 100 pips for profit. 100 pips profit, okay? So we are going to risk 50 for us to get 100 pips. So that means within the day, if the market moves, the movement is between 50 to 100 pips, then on the lower side we can hit the stop loss, on the upper side we can hit the take profit. All right, so let's do that. So we have defined our stop loss equals to 50 pips. All right, now pip value equals to 10. Now let's calculate our lot size on this account, because it's an account of $5,000. So what is our lot size? Lot size will be account balance 5,000 multiplied by our risk factor. 10% is equals to 0.1. Okay, all these divided by our stop loss, which is 50 pips, times pip value, which is 10. So simplify the equation. 500 multiplied by 0.1 is equals to 5,000, sorry, equals to 500, okay, because you move the zero, you move the ni, so divided by 500, so that is 50 times 10. This becomes to 1. 500 divided by 500 equals to 1. So our account, our lot size in this account should be 1 lot. So our maximum lot size we are going to open in this account is equals to 1 lot. Okay, so now you know our account size, we're gonna risk 1 lot. Okay, now let's come here to our account and do it. So when we risk 1 lot in our account, that means that we need leverage. Leverage for us to be secure in that account, because I'm just training you how to double an account of 50 USD. In this case, with an account of 50 USDs, okay, with 1 lot size, at least this we said equals to 5,000 USDC. So at least here we're going to do what? We are going to open 1 lot, and then we need a leverage at least. So from our equation tulisema 1 lot is equivalent to 100,000 USD. Okay, that's what we said. So, and we have our 500. So what is our minimum? What is our minimum leverage? So our minimum leverage will be 303 goes 1, 1, 2. So 1 is to 20. But that means if you open at 1 is to 20, you will be using 100% of your margin. Okay, margin. So your account will have a margin call very fast. Your account will have a margin call very fast. So what are we going to do in this case? We are going to do what? We are going to take this one. We have said it will call a margin call very fast, at 1 is to 20. So even though tutafanya, we are going to at least increase our leverage to 1 is to 100. The reason I've chosen 1 is to 100, it means that when we occupy our 1 lot margin, which is close to 100,000 USD, at least we'll have over 80% unused margin. So our account will be very safe. For us to call a margin call, it stop out a margin call, it will take a little bit time. So in our case here, in our account, tunakuja tuna open 1 lot size, tuna target 50 USD, take profit any 50 pips, TP, no, sorry, not TP, stop loss, and 100 pips TP. If you trade this way, I'm telling you, you don't even need to keep on analyzing market. Wewe unaangalia tu market, unaenda zako. But how many orders can you make when you're doing such? So here we are looking at, in every 10 orders, at least make stop loss. At least stop loss, let's put at the worst. Stop loss equal mingi, which is equals to 6. Take profit is equal 5. No, 4, sorry, 4. 4, because it's 10 orders, 4. So when you make stop loss in there, na take profit 4. How many pips have you lost? It's 6 multiplied by 50, which equals to 300 pips. And here, stop loss, take profit of 4, it's 4 multiplied by 100, which equals to 400 pips. So in short, you have gained 100 pips. So how are you going to open? Of course, we said it's 1 lot. 1 lot. So here you are going to open maybe 4 orders of different currencies. So this 1 lot, you're going to divide it into the number of orders in unataka. Tuseme for example, uta open Euro, USD, you can do 0.3. ukuje tena pound GU for example ufanye nini 0.4 na maybe gold ufanye 0.3, so this becomes to one lot. Okay, so once you subdivide that way, at least it will be even so easy for you to get to that. So on gold, because gold is very volatile, on gold, how are you going to set your stop loss? Stop loss for gold, when you use the same formula, you use dollars, you use USD to calculate the stop loss. So you'll say my stop loss will be 50 USD, my take profit will be 100 USD. Of course it's USDC, kumbuka. So that means if you bought gold at 24.00, your stop loss should be 23, it's a buy, 23.50. Your TP should be 2,500 because gold is volatile. Okay, so for gold, I'm very sure you can hold it 1 or 2 days. When you do this has been very well. I've tested this formula, by the way, for so long, and yet it has really worked. So when you do that, you only need, actually something you can easily make good return from a very small account. When you do this, because you are doing aggressive trading, you are doing aggressive trading. Every day you have an open order. Okay, when you do that, I can assure you within 2 weeks, every banging in an order 100 pips, that account will for sure will grow to not less than 50% within 2 weeks. So what are you supposed to do? Once your account, say for example in 2 months or 1 month, whichever period, once your account, because you are trading 4 sessions, kumbuka here, if you are doing 1 session, at least in Sawa, you can make 30% in every session you give it 30%. Okay, every session we give it 30%. If it's Asian session, give it 30% input. New York session, same 30% input. London session, London session, again give it another 30% input. That means at least you have 90% return in a good period of 1 month or something, if you are doing aggressive trading. But people don't do aggressive trading. You target only 1 session. Like for me, I will target New York session. So my return is just somewhere there, around 30%. That is at the high side, when I'm doing this aggressive trading. So in that way, we are assuming that you are doing aggressive trading, and your account is that. So when your account grows to 100%, first thing, withdraw balance, or balance. Okay, no, not all balance, withdraw profit, profit. So once you withdraw profit, now you are trading risk free. So when you are trading risk free, now you can easily grow your account to maybe up to, now in real money, up to about, not in real money, in real sense, up to around 500 USD, which is equivalent to 50,000 USDC. Now from there, you can convert your account to standard account if you want to. So guys, this is one way of doing it. And one good broker I've seen with the very good sense is DoPrime. DoPrime is a very good broker. DoPrime, actually they were official sponsors of Manchester United. The official sponsors of Manchester United. I've interacted with them and I've seen there is no server issues, there is no problem at all. They have M-Pesa, deposit and withdraw at the same time. Withdraw. They do have withdraw and a CoraPay. It's called CoraPay. Yeah, it's a very big company. So I'll drop a link down there you can create a send account or an account under me, and then I will be having a live session with guys who are interested. We'll be trading together. So thank you. If you have a question, always ask down there. Thank you.